Hello students, welcome to the lecture on production and cost. And after this lecture, we will be able to learn the following objectives. Explain the meaning and factors of production, define the laws of production, discuss the production and equal product curve, understand about the cost concepts, explain the costs in the short run and long run, describe about U-shape of the long run average cost curve. Let's start with the concept of production and cost. It is a characteristic feature of industrial economies that commodities are produced by means of commodities. The idea, popular amongst Austrian economists, that production can be conceived of as a one-way avenue of finite extension leading from the services of primary factors of production, labor and land via a series of intermediate products or capital goods to consumer goods cannot be sustained other than in singularly special cases. Production is typically circular rather than linear or unidirectional. It is another characteristic feature of these economies that production generally requires, in addition to circulating capital, fixed capital. While the circulating part of the capital goods advanced in production contributes entirely and exclusively to the output generated, that is, disappears from the scene, so to speak. The fixed part of it contributes to a sequence of outputs over time. That is, after a single round of production, its items are still there, older though, but still useful. Production analysis is a managerial economics function that focuses on the internal production processes of a company. Managers review internal production processes to determine how efficient the company is using economic resources or inputs to produce goods and services sold to consumers. The word cost has different meanings in different situations. The accounting cost concept or the historical cost concept is not useful as such for business decision making. The accounting records end up with the balance sheet and income statements which are meant for legal, financial and tax needs of the enterprise. The financial recordings reveal what has been happening. It is a historical recording which is not of very much help to the managerial economist in his business decision making. Let us now discuss the meaning and factors of production. A production function is the relation which gives us the technically efficient way of producing the output given the inputs. Actually, cost is the monetary side of the production. Consider the assembly process for an automobile. There are certain inputs like land, building, computerized plant and equipment to manufacture and assemble the car. All these inputs cannot be changed on a short notice. These are fixed in the short run and hence costs associated to these are called fixed costs. However, management can vary the number of workers to some extent depending on the level of production. The central characteristic of long-run production analysis is that all inputs under the control of the firm are variable. The central principle guiding production in the long run is returns to scale, which indicates how production responds to proportional changes in all inputs. A contrasting analysis is short-run production analysis. The analysis of long-run production indicates how a business pursues the production of output given that all inputs under its control are variable. Factors of production. Production is the process of transformation of factors of production, input, into goods and services, output. The factors of production may be defined as resources which help the firms to produce goods or services. In other words, the resources required to produce a given product are called factors of production. Production is done by combining the various factors of production. Characteristics of factors of production. There are some characteristics as given. The ownership of the factors of production is vested in the households. There is a basic distinction between factors of production and factor services. It is these factor services which are combined in the process of production. The different units of a factor of production are not homogeneous. Basic concepts in production theory. The firm is an organization that combines and organizes labor, capital and land or raw materials for the purpose of producing goods and services for sale. The aim of the firm is to maximize total profits or achieve some other related aim, such as maximizing sales or growth. Now moving on to the next topic, we will study the laws of production. A request for production is the discovery, fact-finding, process that occurs prior to trial. Either party may send such a request to an opposing party or witness. If we are served with a request for production, we have a certain time period to provide the asking lawyer with a written reply stating which documents we have in possession and to make those documents available for the asking lawyer to review and copy. Law of variable proportions. The law of variable proportions states that as the quantity of one factor is increased, keeping the other factors fixed, the marginal product of that factor will eventually decline. This means that up to the use of a certain amount of variable factor, marginal product of the factor may increase, and after a certain stage it starts diminishing. When the variable factor becomes relatively abundant, the marginal product may become negative. Assumptions of the law. The law of variable proportions is valid when the following conditions are fulfilled. The technology remains constant. If there is an improvement in the technology due to inventions, the average and marginal product will increase instead of decreasing. Only one input factor is variable and other factors are kept constant. All the units of the variable factors are identical. They are of the same size and quality. A particular product can be produced under varying proportions of input combinations. Returns to scale. The law of variable proportion analyzes the behavior of output when one input factor is variable and the other factors are held constant. Thus, it is a short-run analysis. But in the long run, all factors are variable. When all factors are changed in same proportion, the behavior of output is analyzed with laws of return to scale. Let's know the meaning of production and equal product curves. A curve that graphically represents the relation between total production by a firm in the short run and the quantity of a variable input added to a fixed input. When constructing this curve, it is assumed that total product changes from changes in the quantity of a variable input, like labor, while other inputs like capital are fixed. This is one of three key product curves used in the analysis of short-run production. The other two are marginal product curves and average product curve. Production curves. Each combination of labor L and capital K produces a different level of output Q. Eventually, however, adding laborers adds nothing to output and will eventually decrease output if more laborers were hired. Equal product curves. A curve showing all the various combinations of two factors that can produce a given level of output. An equal product curves is also called an isoquant. The isoquant shows the whole range of alternative ways of producing the same level of output. An isoquant shows the extent to which the firm in question has the ability to substitute between the two different inputs at will in order to produce the same level of output. Equal product map. An equal product map shows a set of ISO product curves. Each isoquant represents a different level of output. A higher isoquant shows a higher level of output and a lower isoquant represents a lower level of output. Diagram and or graph. The ISO product IQ yields 100 units of output by using quantities of inputs X and Y. So is also the case with isoquant IQ yielding 300 units of output. We conclude that an isoquant map includes a series of ISO product curves. Each isoquant represents a different level of output. The higher the isoquant output, the further right will be the isoquant. Cost concepts. The term cost is a frequently used word that reflects a monetary measure of the resources sacrificed or foregone to achieve a specific objective, such as acquiring a good service. The important point is that cost is rarely without considering the type of that. Direct and indirect cost. Direct cost. Those costs that can be specifically and exclusively identified with a particular cost object. As an example, we can mention the wood for manufacturing a particular type of a desk in an organization. Indirect cost. Those costs that cannot be identified specifically and exclusively with a given cost object. As an example, we can mention the salaries of the factory supervisors or the rent of the factory. It is considerable that sometimes direct costs are treated as indirect because tracing costs directly to the cost object is not cost effective. As an example of this part, we can mention the nails used to manufacture a particular desk. Because the expense of nails is insignificant, their cost is not that much considerable for justifying the profit. Explicit cost and implicit cost. Explicit cost. An explicit cost is a business expense accounted cost that can be easily identified, such as wage, rent, and materials. Explicit cost gives clear and evident cash outflows from business that decreases its end result profitability. This cost directly affects the revenue. Intangible expenses such as goodwill and amortization are not explicit expense because these expenses do not show clear effects on a business revenue and expenses. Implicit cost. An implicit cost results if the person who at first forgoes the satisfaction in the search of an activity and is not rewarded by money or another form of payment. The implicit cost begins and ends with foregoing the benefits and satisfaction. Fixed cost and variable cost. Fixed costs. The definition of a fixed cost is one which does not vary in total when the level of output by the business does vary. In other words, when the sales level within a business increases, fixed costs in total would not increase. It also follows that when the sales level in a business decreases, the fixed cost would not decrease. Variable cost. Variable costs are those which do vary as a total cost to the organization when output or the number of items or services produced varies. In fact, a true variable cost will vary in exactly the same proportion as the output.
Variable costs. Variable costs are corporate expenses that vary in direct proportion to the quantity of output. Unlike fixed costs, which remain constant regardless of output, variable costs are a direct function of product volume, rising whenever production expands and falling whenever it contracts. Examples of common variable costs include raw materials, packaging, and labor directly involved in a company's manufacturing process. The formula for calculating total variable cost is total variable cost equals the total quantity of output multiplied times the variable cost per unit of output. Let's assume that hypothetical company XYZ has received an order for 5,000 widgets for a total sales price of $5,000, and they want to determine the gross profit that will be generated by completing the order. First, the variable costs per widget must be determined. Let's assume the following. 100,000 annual widgets are produced, $10,000 are used for raw materials, and $50,000 is used to pay for direct labor. From this information, we can conclude that each widget costs 10 cents in raw materials and 50 cents in direct labor costs. Using the formula above, we can then calculate that company XYZ's total variable cost on the order is $3,000. Therefore, the company can reasonably expect to earn a $2,000 gross profit from the order. When analyzing a company's income statement, it should be remembered that rising costs are not necessarily a troubling sign. When sales rise, more units first must be produced, which in turn means that variable production costs must also increase. Thus, for revenues decline, expenses must also rise accordingly. A company with a large number of variable costs compared to fixed costs may exhibit more consistent per unit costs, and hence more predictable per unit profit margins than a company with fewer variable costs. However, a company with fewer variable costs may magnify potential profits because revenue increases are applied to a more constant cost level. Part of being a successful investor involves making an educated forecast about how a company will respond under different operating conditions. And one of the key determinants is a proportion of fixed costs to variable
costs in the short run. Costs in the short run can be classified into fixed cost and variable cost. The fixed cost may ascertain in terms of total fixed cost and average fixed cost per unit. The variable cost can be determined in terms of average variable cost, total variable cost. Total fixed cost remains fixed irrespective of increase or decrease in production of activity. The total variable cost increases proportionately with production. Here, the rate of increase is not constant. The total cost increases with volume of production. The average total cost decreases up to a certain level of production. Marginal cost. Marginal cost is less than the average cost when the average cost is falling. Average cost. When the average cost is rising, the marginal cost is more than the average cost. The figure 5.13 shows average cost where MC is greater than AC. Cost in the long run. Long run refers to the period of time over which all factors are variable. The firm has more time at its disposal to make any change in the production depending on its requirements. The firm can expand its production, upgrade its production facilities, enter into new markets, initiate necessary changes in the labor force, import technology, or undertake research and development. The firm can plan and organize every strategy to reduce its cost of production or maximize the volume of production. It has no constraints in terms of resources, it has no fixed cost, all costs are variable. So the long run cost refers to the cost of producing different levels of output by changing the scale of production. A long run is also expressed as a series of short runs. It is already expressed that every short run average cost curve is associated with the short run. This explains that the long run is associated with a series of short run of average cost curves. The long run average cost curve, LAC, is flat U-shaped curve enveloping a series of short run average cost curves, SACS. It is tangential to all the SACs. The points of tangency represents minimum average cost in the long run and not in the short run. The long run and short run average cost is equal to each other only at particular points of tangency. Each of the SAC curves is an operating curve which decides the current production level. The LAC curve is planning curve as the long run demand of the product is to be taken into consideration before deciding upon the right size of the plant. The U-shape implies that the cost of production continues to be low till the firm reaches the optimum scale. Marginal cost equals to average cost. Beyond this level, the cost of production increases. In the beginning stages, when the firm unleashes all its potential, that is, releases all its inputs proportionately and simultaneously, it enjoys increasing returns to scale for some time. Of SAC 1, if it wants to produce OX2 units of output, either it can operate on SAC1 by overutilizing SAC1 plant or by acquiring a bigger size plant, SAC2, and operating on it. It will be less costly to operate on SAC2. If it wants to produce OX3 units of output, it can operate on the bigger size plant, SAC, at least cost. X3A3 is the least cost at the output OX3 and the firm attains optimum output in the long run at OX3 level of output. U-shape of the long run average cost curve. Scale economies and returns to scale generally produce a U-shaped long run average cost curve, such as the one displayed to the right. For relatively small quantities of output, the curve is negatively sloped. Then, for large quantities, the curve is positively sloped. While the shape of the long-run average cost curve looks surprisingly like that of a short-run average cost curve, the underlying forces are different. This U-shape is not the result of increasing, then decreasing marginal returns, then surface in the short run when a variable input is added to a fixed input. The negatively sloped portion of this long-run average cost curve reflects economies of scale and increasing returns to scale. The positively sloped portion reflects diseconomies of scale or decreasing returns to scale. Replacement and historical costs. The historical cost of an asset refers to the actual cost incurred at the time the asset was acquired. In contrast, the replacement cost stands for the cost which must be incurred if the asset is to be purchased today. The two concepts differ due to price variations over time. During inflationary conditions, as witnessed today, the replacement cost exceeds the corresponding historical cost, and quite the opposite holds good during deflationary situations. Conventionally, balance sheets are cast on the basis of historical cost. Also, while calculating cost for use in completing firms' income tax returns, accountants are required by law to list the actual rupee amounts spent to purchase the labor, raw material, capital equipment, etc. used in production. For managerial decisions, however, historical cost may not be appropriate. Consider another example. Suppose there is a university which runs all its activities during the daytime. It is considering starting an evening program on commercial basis. The evening program is intended to use faculty time, administrator time, and some time of the clerk cum peon, for whom extra payments would have to be made for their services. In addition, there will be some cost on electricity, chalk, etc. Besides, the classroom of the university would be utilized for the purpose. What are the incremental and sunk costs of said program? The answer is simple. The cost of the time of faculty, administrator, clerk, cum peon, and the amount spent on electricity bill, chalk, etc. will be the incremental cost, and the cost of the use of the classroom and blackboard would be the sunk cost. Now, in the end, let us summarize what we have learned in this lecture. Production analysis is a managerial economies function that focuses on the internal production processes of a company. Long-run production analysis extends and augments short-run production analysis, commonly used to explain the law of supply. Laws of returns to scale refer to the long-run analysis of the laws of production. In the long run, outputs can be increased by varying all factors. The cost of capital is critically important in finance. It plays a crucial role in the capital budgeting decision. Production is the process of transformation of factors of products, input, into goods and services, output.